Hello everyone, it's Wednesday, May 6, and today we will take a look at the charts for the euro and the British pound to identify potential market trajectories. The previous trading day was relatively calm. The euro gained some strength against a weaker dollar, which was pressured by disappointing US economic data. The pound sterling followed suit, managing to recover as well. Specifically, the greenback faced headwinds from a downward revision of the ISM Composite PMI for April. However, US new home sales surpassed analysts' expectations, helping to offset some of the pressure on the dollar. Yesterday, all eyes were on US President Donald Trump and developments in the Middle East. After announcing that the United States had completed its Operation Epic Fury attack on Iran, Trump stated that the country is now ready to engage in negotiations regarding the nuclear program while launching a new humanitarian operation dubbed Project Freedom, aimed at securing shipping lanes in the Strait of Hormuz. It is essential to understand why the president has shifted operations without achieving their objectives or reaching a favorable peace agreement. The answer is straightforward. The 60-day deadline for the war, initiated without congressional approval, expired on May 1. Now Trump's need to formally announce the end of the active phase, which he has done. He unveiled a new operation designed as a humanitarian mission to safely guide over 300 ships stranded in the Persian Gulf. However, the underlying goal of the project appears to be provoking Iran into retaliation. In the simple terms, as soon as military vessels enter the Strait of Hormuz to ensure the safe passage of oil tankers and civilian ships, Tehran is likely to respond with attacks, potentially triggering a new military conflict. This escalation would allow the US to revert to an active phase without congressional authorization. This scenario seems to align with the current US strategy, which makes it premature to discuss a near-term end to the US-Iran conflict. According to some sources, this kind of provocation might occur on May 8-9. This means that traders should exercise caution before buying risky assets. Clearly, demand for the US dollar is likely to persist in the near term. Meanwhile, today's rise in the euro and the pound during the Asian session is directly linked to currency intervention by the Bank of Japan, which has stepped in to support the struggling yen. Thus, it is important to remain cautious as the bearish trend for both the euro and the sterling has not yet been broken. Now let's move on to today's macroeconomic calendar. It features a series of final reports on manufacturing, services and composite PMIs for April for the euro area and its member states. The statistics are expected to be quite disappointing, with readings anticipated to fall below the 50-point threshold, indicating a contraction in both manufacturing and services activity. This could exert additional pressure on the euro. The UK is also set to release its services PMI data. The April reading is forecast to show a positive trend compared to March, which should help lift the composite index. In this context, sterling may gain upside momentum. However, if the figures align with previous estimates, the British pound is likely to show little to no reaction. On the US front, the ADP employment change report will be in focus. Private sector employment is estimated to have increased by 79,000 in April, following a gain of 62,000 in March. This could provide support for the dollar and wane on risky assets. Traders should also pay attention to speeches by Fed officials Alberto Musalem and Austin Goolsbee, as they may provide insights into the current outlook for the central bank's interest rate plans. Turning to technical analysis, The 1-hour EUR USD chart shows that the false breakout at 1.1749 would generate a sell signal, potentially dragging the euro down to 17.23. A break and hold below this level would bring the price down to 17.01 and could open the path towards 16.78. At this level, I would recommend going long on a rebound, targeting an intraday correction of 20-25 pips. Long positions at 17.23 and 17.01 should be considered on a false breakout. In case of muted selling activity at 17.49, going short will be appropriate on a false breakout at 17.67 or on the rebound at 17.84 with the target of 15-20 pips. Shifting to the British pound, a rise driven by positive UK services PMI data followed by a false breakout at 35.98 would create a selling opportunity, potentially lowering the price to 1.3567. If sellers gain control at these levels, sterling could slide to 35.39 and then extend weakness toward 35.14. At this level, it would be wise to go long on a rebound, aiming for an intraday correction of 20-25 pips. Buy entries at 35.39 and 35.67 should be considered only on the false breakout. If selling activity at 35.98 is subdued, the pound could recover to 36.27 and even reach 36.54. Where traders are advised to consider short positions on the rebound targeting 20-25 pip move. Sell entries at 36.27 and 35.98 would only be relevant following a false breakout. Best of luck to everyone.